Welcome to Money Mode, the channel that makes money talk less confusing and way more useful. Let's get into it. Imagine opening your payslip and watching a big chunk of your hard-earned money disappear into taxes. Frustrating, right? But here's the secret most people miss. The tax system actually wants to give some of that money back to you if you simply know where to look. This is personal income tax deduction, one of the most underused financial tools available to every single taxpayer. Let's break down exactly how it works and how you can legally lower what you owe step by step. First, understand this. A deduction is different from your income. It's an amount the law allows you to subtract from your earnings before your final tax is calculated. The lower your taxable income becomes, the less tax you end up paying. Simple concept, but genuinely powerful when used well. Every taxpayer starts with a personal allowance, a fixed deduction just for existing as a registered taxpayer. No paperwork needed here, it applies automatically the moment you file. Next comes the family group, and this is where many people leave money on the table. If your spouse has no income of their own, you can deduct further for them. Each child adds another deduction, and if that child was born more recently, the allowed amount can actually be even higher than for an older sibling. Supporting elderly parents, whether your own or your spouse's, unlocks another allowance, as long as they meet certain income and age conditions set by law. Caring for a family member with a disability opens up yet another deduction entirely. Expecting a baby? Prenatal care and delivery costs are deductible too, within a clearly set limit per pregnancy. Then there's the insurance and investment group, often the biggest opportunity of all. Life and health insurance premiums for yourself can be deducted, up to a combined ceiling each year. Paying for your parents' health insurance adds even more room. Social Security contributions taken from your salary count too, automatically. For the future-focused saver, retirement funds, provident funds, and pension-style life insurance all qualify, each with its own percentage of income cap, plus one combined ceiling across the entire retirement group. Long-term equity funds designed to support the local stock market offer another deduction path, again capped as a percentage of your annual income. Homeowners shouldn't forget mortgage interest either, deductible up to a set limit every year, a benefit many people overlook completely simply because it feels unrelated to tax season. The donation group rewards generosity in a very direct way. Giving to education, sports programs, or public hospitals can sometimes double your deduction value compared to the amount you actually donated. General charitable donations are deductible too, capped as a percentage of your net income after other allowances. Political party donations have their own, smaller, separate limit. Finally, keep an eye on government stimulus measures. These change from year to year, sometimes covering verified electronic shopping receipts, sometimes rewarding domestic travel spending. They're temporary windows, so timing your purchases carefully really does matter if you want to capture them. Here's the real magic. All of these deductions stack together. A married taxpayer with children, aging parents, insurance policies, and retirement investments can combine allowances into 6 figures, sometimes far more, before any tax is even calculated on what remains of their income. Let's make it concrete. Someone earning a solid yearly salary, married with one child and paying into insurance and Social Security, could realistically reduce their taxable income by several $100,000 baht before the tax brackets even apply. That difference can mean paying a noticeably lower rate, or in some cases, owing very little tax at all. The catch is this: most of these deductions aren't automatic. You need receipts, certificates, and proper supporting documents, and you must actively claim each one when filing your return. Miss the paperwork, and you miss the benefit entirely, even if you technically qualified. So before the filing deadline arrives, sit down and map out your entire year. Did you get insured? Support a parent? Welcome a new child? Donate to a cause you believe in? Every single receipt could translate into real money back in your pocket. This is general education, not personalized tax advice, so always double-check current rules and exact limits with a tax professional or your local revenue department before filing. Understanding your deductions is the first step toward keeping more of what you honestly earn, legally, every single year.